So, I've been getting a ton of questions lately about the YieldMax ETFs, and one question keeps popping up. Is ULTY still the king of YieldMax, or is YMAX about to take the crown? Well, buckle up, because today we're going head-to-head, ULTY versus YMAX, two of the most talked about weekly dividend ETFs in the market right now. We're going to break down their yields, payouts, share prices, strategies, and, of course, which one I personally think is better for income-focused investors. Now, if you're new to YieldMax ETFs, here's the quick rundown. YieldMax is famous for launching high-yield covered call ETFs. These funds are basically built to squeeze as much income out of the market as possible, even if it means sacrificing some capital appreciation along the way. It's like trading in your Lamborghini for a delivery truck. You're not going anywhere fast, but you're hauling serious cash every week or month. So, let's start with ULTY, one of the earlier stars in the YieldMax lineup. As of right now in August 2025, ULTY is trading at $6.03 per share. The latest payout was 10 cents per share, and here's the big number. Its distribution rate is sitting around 87% annually. That's a monster yield, and it's why so many income investors have been flocking to it. ULTY's portfolio is actually pretty diversified for a YieldMax ETF. It holds positions across over 118 companies. This is important because unlike some YieldMax ETFs that focus on one single stock, ULTY spreads its risk a little more. This means if one stock tanks, the whole fund doesn't get wrecked overnight. Now, the whole appeal of ULTY is that it pays weekly dividends. Every single week, money is hitting your account. For a lot of early retirement or cash flow focused investors, that's a dream setup. But here's the catch. Those high yields don't come without trade-offs. Because of the way YieldMax runs their covered call strategy, ULTY doesn't benefit as much from stock price growth. If the market takes off in a big rally, ULTY might lag behind because it's constantly selling call options against its holdings. All right, now let's talk about YMAX, the new heavyweight challenger. YMAX is also a YieldMax product, but here's the twist. Instead of being tied to just one stock or a small theme, YMAX is a fund of funds. Basically, it's holding a bunch of other YieldMax ETFs inside of it. So, in a way, you're getting a YieldMax ETF that invests in other YieldMax ETFs. Yeah, it's a little Inception-like. This means YMAX is super diversified across the YieldMax universe. You're not just betting on one covered call strategy tied to one company. You're betting on the entire YieldMax income machine. Let's get into the numbers. As of right now, YMAX's current distribution rate is sitting at about 65% annually. That's lower than ULTY's 87%, but don't tune out yet, because yield isn't the whole story here. The latest payout from YMAX was 16 cents per share. And yes, like ULTY, it pays weekly. So right out of the gate, you might think, well, 87% yield beats 65% yield. End of story. But here's where it gets interesting. YMAX's underlying strategy might offer more stability over time. Since it's made up of multiple YieldMax ETFs, it could smooth out some of the crazy swings you get from single stock-focused funds. For example, ULTY has had weeks where the payout dropped sharply from the previous week. That's just the nature of its covered call income on a volatile basket of stocks. But YMAX, because it's pulling income from multiple ETFs, could keep its weekly payouts more consistent. And for some investors, consistent is just as important as big. Let's talk share prices for a second. As of this week, ULTY is trading at about $6.03. That's low enough that a lot of investors like to buy it in large chunks for reinvesting. You can scoop up hundreds of shares without needing six figures in your account. YMAX, on the other hand, trades higher, like in the mid to upper teens depending on the day, so your dollar goes a little less far in terms of share count. But remember, the yield percentage already adjusts for share price, so you're not actually losing income just because the price is higher. Now, let's break down the $10,000 question, literally. If you took $10,000 and split it into each of these ETFs based on their current yield and latest payouts, here's roughly what we're looking at. With ULTY's yield of about 87%, you're looking at close to $8,700 a year in distributions. Before taxes, of course. That's insane income, but remember, that number assumes the current payout rate stays the same, which in reality, it probably won't. Covered call income fluctuates based on volatility, stock price movement, and option premiums. With YMAX's yield of around 65%, $10,000 invested would give you about $6,500 a year in distributions. Still huge, but a bit less than ULT. Again, though, potentially with more stability and less dependency on just a handful of companies' stock prices. The real debate here comes down to one thing. Do you want the absolute maximum yield right now, even if it's more volatile? Or do you want slightly less yield but potentially steadier payouts over time? For me, I think YMAX is super interesting because it's like getting a basket of YieldMax's best income strategies without having to pick just one. It's like ordering the sampler platter at a restaurant. You're not committing to one dish, you're getting a taste of everything. But YieldTy still has a serious advantage for pure cash flow hunters. That 87% yield is hard to ignore, and for someone who wants to maximize income today, maybe for early retirement or to supplement a fixed income, it's an absolute powerhouse. Here's another angle. Risk exposure. YieldTy holds over 118 companies, but it's still operating under one covered call structure. If something changes in the market that impacts that strategy, like volatility drying up, the payouts can drop fast. YMAX, by being invested in multiple YieldMax ETFs, could spread that risk around a little better. And before you ask, no, neither of these is a set-it-and-forget-it kind of ETF. If you're holding ULTY or YMAX, you need to keep an eye on their distributions because they can change a lot month to month. That's just the reality of high-yield option income products. One last thing I want to address, price stability. Both ULTY and YMAX, like most covered call ETFs, tend to drift down in price over time. This is because they're constantly paying out so much income that they don't retain much to grow their share price. The strategy is designed to return cash to you, not grow capital. So if you're buying these, don't expect them to double in price over the next few years. Expect the income, not the appreciation. So here's where I land on it. If I had to choose right now and I was purely chasing maximum weekly income, YieldTy still wins. That 87% distribution rate is just crazy. But if I wanted something with a still massive yield, plus a bit more stability and diversification in the strategy, YMAX is a really solid choice. It's almost like YieldTy is the sports car, thrilling, high performance, but a bit wild. While YMAX is the luxury SUV, still powerful but smoother and more comfortable for the long haul. Either way, both of these are part of the elite tier of income-generating ETFs right now, and they're reshaping how investors think about cash flow from the stock market. Just remember, high yield comes with high risk, and you've got to keep your eyes open. Don't just chase the biggest number. Make sure you understand how these ETFs make that income and what can cause it to change. And with that, I think we can say the fight between ULTY and YMAX is just getting started. This might not be the last time we see a title change in the YieldMax world. If you found this breakdown helpful, hit the like button and subscribe to Money Stick Unfiltered, where we analyze weekly income ETFs and faceless finance strategies so you don't have to do the digging.